Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Wednesday, July 15th, 2026, and we have a genuinely packed show today. Yesterday's surprise CPI print is driving a broad market rally, big bank earnings are rolling in, and crypto is bouncing back after a rough session. Let's get straight into it. Lizzie, big picture. We've got a surprise CPI print showing consumer prices actually fell in June. What's the immediate read-through for markets?
Morning, Robert. The read-through is straightforward. Softer inflation means less pressure on the Fed to hike, and that immediately lifts rate-sensitive and high-growth names simultaneously. The Nasdaq, S&P 500 and the Dow all opened higher on Tuesday, with tech leading the advance, and that momentum is carrying into this morning. What makes this particularly notable is that you're getting two catalysts at once, rate relief and an AI narrative that Fed Chair Warsh reinforced with his commentary. And that dual tailwind is creating real conviction in the move rather than just a reflexive bounce.
Speaking of the Nasdaq leading, is this purely a rates trade, or is the AI narrative from Warsh adding another layer to the tech rally?
It's both, and that's what gives this rally more texture than a simple inflation trade. When the Fed chair publicly highlights the AI movement as a structural force, it validates the capital expenditure cycle that tech companies have been running, and it signals that the Fed is watching productivity tailwinds alongside price stability. Rate-sensitive growth stocks benefit from the CPI miss on pure duration math, but the AI overlay means investors are also re-rating the earnings potential of the Nasdaq's largest constituents, so you're getting multiple expansion and improved fundamental sentiment working in the same direction at the same time.
Meta is up 23% from recent lows after pivoting to leasing out excess AI compute capacity. Real fundamental story, or momentum chasing ahead of earnings?
Honestly, it sits right in between those two things right now. The move to monetize excess compute is a shrewd near-term play, and it explains the chart crossing back above the 200-day moving average for 2 consecutive sessions, which is technically meaningful. But the real test is the upcoming earnings report. Specifically, CapEx figures, free cash flow trajectory, and what management says about monetizing AI investments at scale. Until those numbers land, you're trading a narrative, and narratives can reverse quickly if the CapEx story disappoints.
Big bank earnings are hitting today and tomorrow. Goldman already showed strength yesterday, but analysts are warning much of the good news may be priced in. How are you thinking about the risk-reward into these prints?
The setup is genuinely tricky because the expected numbers are strong across the board. Goldman is looking at over 32% EPS growth year over year, Morgan Stanley near 36%, Citigroup approaching 39%, and Bank of America around 27%. But the KBE Bank ETF is already up 12.4% year to date, outpacing SPI's roughly 10.5% gain. So a lot of that optimism is already in the price. The real question for traders is whether these banks can meaningfully beat elevated expectations rather than just meet them. And analysts at UBS and HSBC are both flagging that the sector may be approaching peak momentum. The risk-reward at these valuation levels is asymmetric. You need a significant beat to move stocks meaningfully higher, but an inline print or soft guidance could trigger a sell the news reaction.
Tesla got price target raises from Morgan Stanley, Barclays and Wells Fargo and barely moved. What does that tell you about investor sentiment on the stock?
It tells you that sentiment on Tesla is deeply uncertain right now, and that price target revisions alone carry very little weight when underlying conviction isn't there. Morgan Stanley lifted their target by just $2 to 400 pounds while keeping a hold rating, which isn't exactly a ringing endorsement. And when 3 firms move targets and the stock can't find meaningful traction, the market is essentially saying it needs to see fundamental execution rather than analyst optimism before it re-rates higher.
On the avoid list today, VRSK, LMT, ENS and BC. Is there a common thread in why analysts are steering clear of these names?
There is, and it comes down to the same fundamental problem across all 4 names: sluggish revenue growth combined with valuations that don't offer enough of a discount to compensate for weak underlying business momentum. Verisk has a 5-year revenue DOR of just 1.9%, Lockheed is at 2.6% with declining EPS, Brunswick at 2.8%, and Ensys hasn't grown sales volumes in 2 years, and they're all trading at forward PE multiples in the 17 to 23 times range, which looks unattractive when the growth profiles are this modest and the broader market is offering higher quality alternatives in semiconductors and high momentum technology names.
Steve, let's bring you in. Walk us through the CPI numbers from yesterday. What exactly came in versus expectations and versus the prior reading?
Yesterday's June CPI came in at 333.95 on the index level, which was a notable downside surprise against the forecast of 334.7 and a meaningful decline from the prior May reading of 335.12, meaning consumer prices actually fell month over month in June, the kind of print that immediately shifts the rate hike calculus at the Fed. The miss versus consensus wasn't enormous in absolute terms, but the directional move, prices declining rather than rising or even holding steady, is precisely what drove the broad market reaction and the cooling in rate hike expectations that's underpinning today's rally across tech and rate-sensitive sectors.
And what's on the economic calendar for the rest of the week?
Today is itself a significant data day because June PPI, the Producer Price Index, is due out this morning, and traders will be watching closely to see whether the disinflationary signal from CPI extends to the producer side of the economy, since soft producer prices are often a leading indicator for future consumer inflation and would reinforce yesterday's surprise considerably. Then on Thursday, we get initial jobless claims for the week, ending July 11th, with consensus sitting at 217,000 against a prior reading of 215,000. The labor market is still showing resilience, and any meaningful deviation from that range will attract attention. And Thursday also brings June retail sales, which is a key read on consumer spending health heading into the back half of the year. Then rounding out the week on Friday, we get both the Consumer Confidence Index and the University of Michigan Consumer Sentiment for July, with forecasts on both sitting around 51 against a prior of 49.5, and given yesterday's softer CPI print, there's a reasonable case that consumers are feeling incrementally better about price pressures, which could support an upside surprise in those reads.
Lizzie, over to crypto. Bitcoin slid to $62,000 yesterday on US-Iran tensions and is bouncing back above $64,700 today. How fragile does this recovery feel given the macro backdrop?
The recovery has a tentative quality to it because the macro headwinds that drove yesterday's sell-off haven't fully resolved. Geopolitical tensions and the rate hike risk they carry are still live variables. That said, the bounce is occurring on broad altcoin participation, with Ethereum up nearly 5.7% to $1,872, and Solana advancing about 2.4% to $7,725 ASR, which suggests buyers are stepping in across the market rather than just squeezing a single asset. And the iShares Bitcoin Trust ETF, breaking an 8-week outflow streak last week with 86.8 million in inflows, is a constructive institutional signal, but Bitcoin still needs to convincingly reclaim and hold levels above $65,000 before this recovery feels durable, rather than purely reactive to a macro relief trade.
The US government moved $288 million in seized Bitcoin and Ether to Coinbase Prime. Markets are reading that as a potential sale. How significant is that overhang?
In isolation, it's a relatively modest overhang, because $288 million represents only a small fraction of the government's total crypto holdings of approximately $20.65 billion, which includes over 324,000 BTC. But the more significant concern is the optics. These transfers appear to conflict with Trump's March 2025 executive order, establishing a strategic Bitcoin reserve and prohibiting sales of seized Bitcoin. Coinbase Prime does provide custody and staging services, rather than just exchange access, so a sale isn't confirmed. But the market tends to treat exchange transfers as preparation for liquidation regardless of the technical details, and that creates a near-term sentiment overhang that keeps a lid on aggressive buying until there's clarity on whether this is custody movement or active selling.
XRP is showing serious whale accumulation, 900 million XRP bought in 48 hours. And there's growing buzz around a potential BlackRock XRP ETF. Is this a trade worth watching?
It's worth watching closely, though I'd characterise the risk level as elevated. The 900 million XRP accumulated in 48 hours is the largest whale buying since June 2025, and that kind of concentrated accumulation often precedes meaningful price moves, but the ETF catalyst is still speculative. What's in development is a standardised crypto ETF framework being coordinated with CBOE, Nasdaq and NYSE, and a BlackRock iShares XRP trust would only materialise under that framework if approvals move forward. XRP was sitting at 295 in the latest snapshot, and the momentum is real. But traders need to keep position sizing disciplined here, because if the ETF timeline slips or macro sentiment deteriorates, the whale accumulation narrative alone won't hold the price up.
That wraps up today's Morning Bell. Thank you to Lizzie and Steve as always. Remember, this is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.